I'd like to thank all of the industry partners that we have and trade associations that have been so kind as to advertise this to much of their membership. I'd like to especially recognize NEMRA, AMAR, STAFTA, PTRA, MRA, ERA, and forgive me if I've forgotten somebody, but thanks again for bringing this to bear. John, if you'd like to go ahead and go forward. So today we're very excited to bring John Vrablic from T.I.P.S for Reps. John and I have known each other for about 20 years, mainly because he helped me during my own rep planning and mergers and acquisition scenarios. So I've known John for a while. He's excellent at what he does. Today he's going to speak with us a little bit about the the overall COVID-19 economic impacts, as well as how to retain your key employees, talk a little bit about succession planning, and other key elements to the long-term life cycle of financial health for your rep business. John is the founder of T.I.P.S for Reps. It's a tax, investment protection, and succession planning company. As a boutique business and wealth management firm that's been specializing in manufacturers reps for over 20 years. He's also an instructor at CMPR in succession planning. So CMPR is Certified Professional Manufacturers Rep, and is often a guest speaker at various rep associations. So John, with that, go ahead and take it away.
Great. Thank you, John. And thanks, John, for want to thank John for inviting me to be a guest presenter here. I appreciate the time, and it's good timing to discuss all this. So we'll just jump right in. So first, what I always want to do, everybody, is kind of have the goals of the webinar kind of established, because usually with webinars, sometimes you'll go through a webinar and at the end of it, you'll say, wow, that was great information. And then a week later, it kind of, you forget about it. So I really want to outline some takeaways for everybody that's attending this. So first takeaway is, what is the economic impact of the COVID? Second is, what's the economic impact to you? So we're going to talk through the economic impact to you as rep agency owners, key salespeople, and what financial impact does that have on you? And then what do you do to protect yourself against this financial impact? So I'm going to circle back to the slide at the end, but at the end, I want to make sure that everyone has a takeaway on this, that you have what the risk is associated with this COVID and your retirement and succession plan, and then a solution for you as well. Same thing on the compensation of key employees. I want everyone to walk away with a tangible solution or a tangible talking point that they could actually implement for their business. And then we'll talk about how the impact is on any existing buyout plans, which may or may not apply to some of the attendees here. And then we'll briefly talk about mergers and acquisitions and how that may be an opportunity with what's happening. And then we're going to talk about new and proactive key employees. So then what do you do now that you know what we've gone through? We know the financial impact and any existing plans that you have going forward. How do you proactively protect yourself and provide quote unquote risk management? So we've customized our risk management retention employee. We call it retention, incentive, and succession of key people. So you're going to walk away with basically a process of how do you protect yourself against future issues or economic issues that we're currently going through. So first, the financial impact. So obviously, one that might hurt everyone's pocketbook the most is the S&P 500. So the S&P 500 / Dow Jones, basically the stock market. So here you see what the stock market has done. The S&P 500 was at its peak in February 12th, and then it went skyrocketed down literally in 1 month down to 2447, which was about a 27 to 30% drop in the investments. So just as a quick aside, obviously no one likes going through that. No one likes to see their portfolio drop 20-30%, but just one intermittent takeaway on this is do not get out of the market. So here's a very interesting slide that just shows here if the S&P 500 from January of 1999 to December of 2018 had some volatility, not quite as extreme as the COVID, but it has happened. Now, if that happened before, from 1999 to 2018, had you stayed invested and didn't do the knee-jerk reaction of, oh crap, I got to get out of the market, you would have returned 5.62% in the S&P 500. Now, if you got out and missed just the 10 best days from 1999 to 2018, your rate of return would have been 2%. And here's the most interesting thing. So here it says 6 of the best 10 days of market performance occurred within 2 weeks of the 10 worst days. So I can envision one of the participants or attendees here potentially might have a knee-jerk reaction to get out, but if you get out of the market or you go re-diversify back more into cash, you may miss 6 of the 10 best days. So that just the takeaway to this is stay fully invested. Just quick economic figures. This is the unemployment insurance claims made per week in the United States from January to April. You can see there's obviously a sharp incline. This shows the change in the share of U.S. adults who think the COVID is going to have a major threat to their personal financial situation. So as of this poll, based upon this company called Statista, almost 50% of the people think that this COVID is going to have a major threat to their personal financial situation, which is, we're going to talk about how to overcome some of those threats. Now I'm going to hand it back to John, because there's some really interesting things that John does on polls.
So what we've done is we've polled many of our rep groups, and some of you who have been on the COVID-19 business recovery webinars may already be familiar with these slides, but for those of you that haven't been, what we've done is we polled many of our rep firms, our rep agencies. I think about 100 responded, and we asked them, hey, what do you think May commissions are going to look like for you? Since these, since COVID really took hold in late February and early March, most likely with the 2-month offset or 60-day offset from your commission cycle, it was, everybody recognizes that May, June, July are going to be some tough months for our rep groups. And with that, when we polled them, what they said was that how would you anticipate your upcoming commissions in June? What you can see here is in May, most people felt that it was going to stay even or a 5 to 20% loss, with some people, especially those in exposure to the really tough markets like the restaurant business, for example, those guys are obviously feeling it from 20 to 40 or slightly worse. So that was what May looks like. John, if you could continue to June. June looks like it was also a little bit worse. Fewer people were staying even. So this is when we were starting to hit the trough. And then you see that there's a lot more people in the down 5 to 20%, a lot more people in the 40% or more down. So June commissions in general from our rep groups are expecting it to be a little bit, more brutal. And then third quarter, what does that look like? And John, if you could look at this one, what you'll also see is that there are some lasting effects in the 20 to 40% down loss category. So on average, when we did the math, it ends up being about everybody's anticipating roughly 30% down. Now, one thing that's a positive note is that within these 3 brackets of time, most rep agencies don't expect to be down 40% for very long, right? In other words, if they're going to be down in May and June because of the immediate impacts, they typically did not expect to be down that much in third quarter as things start to recover. Or likewise, if they were stable in May and June, they do expect to have a tougher third quarter. And so the point being is that the impact seems to be really focused within a few months for most of our rep agencies. With that being said, John, you can take it back over for how this impact's going to affect people.
Great. Let's hope so. Let's hope this is a short-term thing. Summer's coming and we want to get to the pool, so let's hope this gets fixed. Okay, so COVID impact on your retirement and succession plan with your key people. So the following are very significant economic impacts that the COVID could have or are having on your retirement and with your key people planning, key person planning. So one, or A, obviously could impact the valuation of your agency for buyout purposes. B, the stock market loss and how that could impact you from your retirement. And then C, uncertainty with your key employees with the economic downturn that we've had, are they feeling still confident that the long-term succession plan is going to come to fruition? So let's take them one by one. So the first one is valuation. So if you plan to sell your agency or have a plan in place the next few years, your value obviously is going to be impacted. And the question that I'm going to pose rhetorically, obviously, is do you know the financial impact on your retirement with that lower number? And I'm going to walk you through an example of that as well. Because most buyouts that I review, most buy-sell agreements, basically say there's a 3-year average of gross commission. Well, as John mentioned, if the average downturn is 30%, that's obviously could be a 30% downturn in the valuation formula, which would have a significant impact on you. So here's an example. So here you see 30% loss in 2019. So just using this simple example, in 2016, if the buy-sell agreement said, at my triggering event of death, disability, or retirement, the value of the agency will be a 3-year average of gross commission. And at the end of 2018, based upon these numbers, the 3-year average would have been 1,308,000. But now let's assume in 2019 goes down 30%, which is 962. And let's assume also we have a remarkable recovery and we're almost back to even in the next 2 years. Well, you could see that would produce $135,000 loss. Now, I don't know about you guys and gals, but $135,000 lost in my pocket for retirement is going to have a financial impact. So we really got to think through valuation. And again, do you know what financial impact potential lower valuation would have on your agency? And I'm going to get to the solution in a little bit. The first problem is the valuation. The second is the stock market loss. So couple, in my example, $135,000 loss in value and couple that with a 20% loss in the market. Now you got a double whammy. So if someone had 2 million of investments, that could be a loss of $400,000. So the total loss of financial security, so to speak, is in this example is $535,000. Again, do we know how that looks? What financial impact is that going to have on my overall plan to retire? And can I or should I be able to communicate that with my key people? Third is key employee certainty. So obviously with what's going on, some of your key employees, if they're either in a current buyout, which we'll talk about, or whether there's discussions about a long-term retention plan, they might have some uncertainty. So with this uncertainty, it's, you may have the knee-jerk reaction is, I don't want to talk about it. But really what we're going to suggest is you really want to be open with your key employees. If you're in a buyout, obviously we'll talk about that. If your buyout's going to be 2 or 3 years, we need to seal that up, make sure, as we'll talk about in the next slide, how to protect yourself and how to make sure that you can actually retire when you want to retire and stick to the plan. But really, uncertainty is no good. So we want to make sure that, at least from my opinion, we should always communicate and have full disclosure with our employees that, hey, we're going through a time, but here's what we're going to plan on doing, as we will see in the next few slides. So those are kind of the financial impact and economic issues as it relates to the valuation, as it relates to the key employees and your exit plan. So what do you do? So on the valuation side, you should review your valuation and or your buy-sell agreement. Most rep agencies that I speak with, they do their buy-sell agreement, which is great, but it's basically one of those where they do it, they put it in the drawer, and then 10, 15 years later, when something comes up, then they relook at it. So we really should be looking at not only your existing buy-sell agreement, but the formula or the valuation formula. Because what I find working with 200 plus rep agencies the past 20 years is most agency valuations do not represent what a true value is of a rep agency. And many times there's valuation formulas in there that will seek a third party appraiser. Well, unfortunately, a lot of third-party appraisers do not understand how rep agencies are valued. So one of the minor takeaways on this discussion is rep agency valuation is not just an average of annual gross commission generated. That's a misnomer, because I can have an agency doing $1.3 million of gross commission and another agency doing $1.3 million, and the first agency I could value at 1.8 million, the second agency I could value at 800,000. Why the disparity? It's cash flow. So it's not necessarily the gross commissions that are generated, it's the net cash flow that's available from the company standpoint to make payments to the exiting shareholder. So obviously, in my example of the $1.8 million valuation, the agency owner might have had a compensation package of 350,000, profits of 50,000, a profit sharing plan contribution, so on and so forth. So at his or her exit, that money is available to use as cash flow to make payments. You know, change the scenario. In my 800,000 valuation example, the owner may be taking out 100,000 and there isn't any profit in the company. Obviously, the $1.3 million agency with a higher cash flow is more valuable. So your valuation should try to accommodate for a COVID anomaly. So the valuation in your buy-sell agreement should be based more on a percentage of payout versus a number. And we do that with what we have our own valuation formula and process that we do with our rep agencies that is custom for reps. We call it our quote unquote representative value. And what it does is you should try to take into consideration, you know, commissions going up, commissions going down, and it should be a formula that is malleable, for lack of a better way of saying. So what to do on your valuation? Relook at it and update it to make sure that it does take into consideration some type of anomaly like that, so that you don't get hit if you're retiring next year and you're using a 3-year average and you lose $135,000. That wouldn't necessarily be fair to you as the rep agency owner. 2, on the stock market loss. So what you should do, what should you do when everyone's had a 20% downturn, could be 30% downturn, and what does that look like financially? Well, you should have a cash flow retirement model performed that will illustrate the impact in the ability for you to maintain your retirement plan, and by extension, you know, your key employee plan. So I'm going to show you an example of what that would look like, and what, using my example of the 135,000 loss of value and a 20% stock market downturn, what does that look like from a financial perspective? So hold on one second. I'm just going to pause this for a sec and show you this. All right.
So John, there we go. The asset.
So yeah. So here's the example of kind of how we outline the assets. This is a very simple example. You got the rep agency owner here. You got the value of the rep agency at 1.3 million, which is what I said. And you have after-tax investments of $1.5 million. And so what ends up happening is, if you look at the scenario where prior to this stock market crash happening, what does their financial picture look like? You can see here that their financial picture is green. Green's usually good, so it's all green, and it takes them out to age 85. Now you're in a scenario where, we just lost value to the company and we lost 20% in the stock market. What impact does that have? And you'll see here, we took into consideration the rep agency value went from 1.3 to 1,173,000, and the assets went down a little bit. And so now the retirement plan is only 85% funded. And you can see here that with that downturn in the value and the downturn in the stock market, this literally could impact their financial picture. So the takeaway to this is you should have a financial model, wealth management model redone based upon the current situation of where your portfolio is and what potential value you have on your agency now. So I'll get back to the presentation. Okay. So what you should have as it relates to that is A, you should have a wealth management financial model done. 2 is you should have an investment policy statement that takes into consideration your overall investments, and you really should have a deep dive into your existing portfolio to make sure that you can protect against the downside. We happen to have with our investment management team, we have something called the 10 laws of investment management, which is a process to protect against the downturn, and we have some report card type analysis that will score an existing portfolio, and as well as an investment stress test. Bottom line is, whoever it's with, you really should relook at your overall financial picture, see what financial impact there is, and then going forward, you really want to make sure from an investment standpoint that you potentially can protect against another 20-30% downturn. Key employee certainty of the succession plan. So assuming you update your valuation formula, that's good. Assuming you relook at your wealth and retirement and you can confirm that you can still achieve your retirement goals, then you really should be able to communicate that with your key person. So that's the key behind the communication. Obviously, if you don't know what your financial picture is going to look like and it's up in the air, then it's difficult to communicate that to your key employees of what your plan is, whether you're going to retire in 2 years, 3 years, whether you want to continue to on with the buyout plan as proposed, et cetera, et cetera. So the COVID economic impact on compensation. So obviously, with the economic situation, might be a little bit more difficult to pay key employees right now, and more than likely, though, the key employees aren't going to leave. But this is a great time. And I tell my kids, through chaos, there's always a good opportunity. So if we have our eyes and ears to the ground, there's always a good result that comes from a bad thing. This is one of them. This is time to really relook at your overall compensation plan. Now, John works very closely with Brian Shirley. Brian Shirley's former president of MANA. I know Brian fairly well. In addition, I've worked with Brian. He's got a great presentation on compensation plans, and if anyone wants compensation kind of a review, he's the person to talk to. But John has done a great job also of kind of coordinating that with Brian. I'll let John pick up here and basically go ahead.
And so yeah, with those various compensation models, a lot of this depends on the level of information that you get from your manufacturers for what accounts you can tie to the specific behavior of your salespeople. There are various models, but they really all bake down into one of about 4 or 5. And what you can see here are things like straight salary, a salary plus bonus, a salary plus commission, where that salary might be 40 to 60%, and the commission amount makes up for that difference. And then there's things like straight commission, which is in a sense a salary that you can take back depending on the performance of the company. So within Vrablic, of course, we model all of those things, and our sales and commission tracking backend engine helps you support any one of these models and even hybrid versions of them for specific manufacturer statements that maybe you don't get all the full detail of who their ship to customers are and who in your company calls on those and cause that sale. But with that, basically, I think where it all boils down to is now is a good time to look back at those compensation plans because of the hit that is coming, and determine whether or not you want your employees to share in some of the burden, whether you as the rep owner are going to absorb the full impact of it on your own financial situation, and then ultimately come up with a plan that keeps your overall agency as healthy as possible. And John will talk a little bit about the options for profit sharing that might be a fairly good vehicle for doing that. From what we've seen in our groups, we've seen it in various modes where, based on what the company revenue did, everybody would agree as a group, or the owners would say, hey, rather than having to terminate any employees if we need to, and hopefully you won't need to, let's all agree to take this hit and come back at a reduced salary, or vice versa. Other folks are saying, hey, I'm ready to terminate this person, and we should have, maybe already done it even pre-COVID-19. So the point is that these compensation plans and the profit sharing plans really need to be looked at now, because there's so much unrest and concern in the market for, what is my paycheck, when is it coming, and what's that going to look like. So if you can get front end eyes on that, and that's what you see in our manufacturers COVID-19 recovery planning webinar that we did with Brian Shirley. That webinar talks about some of the techniques to be able to project what you anticipate your commissions to be based on sales that have occurred, based on your PO and booking backlog, and then ultimately the deal funnel that you plan to win in the upcoming months. So with that, John, maybe you want to talk a little bit about the profit sharing?
Yeah, so in my opinion, I mean, again, work with a couple hundred rep agencies the past number of years, and the rep agencies that I see are the most successful are the ones that do communicate with their key employees and have more of an open book. A lot of rep agency owners want to kind of be close to the vest and don't want to kind of share with some of their employees. I happen to believe, it's better to share, and yeah, it might be giving some information away, but bottom line is the agencies that I see are most successful have some type of a pool plan, profit sharing plan, where the key employees particularly are sharing in the profits of the company, and they're treated almost like owners. So the byproduct of having a profit sharing plan is obviously, if they're a key employee and they're vying to be a potential successor or an heir apparent, then they are going to have to take the good with the bad. If that's really what they want to be as an owner, then as a key employee and as part of the profit sharing plan or the pool plan, if the revenue goes down the next 3 or 4 months, they're going to suffer along with it, just like you as the owner, if you're an owner. So in that sense, that would allow your plan to be affordable, because you'd be able to make the payments to the key people because it would be commensurate with the revenue that's generated. So in my opinion, the pool plan is good. Another thing that I didn't put into the slide was a true profit sharing plan. So obviously, profit sharing plan has two definitions. A profit sharing plan is just a sharing of the profits at the end of the year that get distributed to the key employees. The second type of profit sharing plan is actually a qualified profit sharing plan. Now, there's certain qualified profit sharing plans that you can incentivize your key people to say, based upon the profits of the company, not only will you have a share in the bonus profit sharing pool, but there's going to be a potential profit sharing plan contribution on a tax deductible basis into the profit sharing plan. Now, why is that good? It's obviously a financial incentive for the key employees, and they see that they're part of not only the bonus pool but also the profit sharing plan, as almost as owners would be. But from a financial standpoint, and through this economic crisis we're going through, you don't have to fund the profit sharing plan up through September of 2021. So if there was ever a time to look at incorporating some type of financial incentive plan as a profit sharing plan, you could do that now, and probably with maybe the help of the PPP program, and then the timeline, you could, promise a benefit. Don't want to renege on the benefit. We want to promise the benefit, but you wouldn't have to fund the benefit till September of 2021, which should give us hopefully enough time to fund that benefit. So that's compensation of key employees. What's the impact on an existing or future plan with your key people? Well, if there's a current buyout, then, and if the payments are fixed on the current buyout, obviously that's an issue. So if someone was purchasing an agency, or there was a buyout that was happening, or a buyout that would happen, that said it's a 3-year average of gross commission, and that's the number, and it's $1,500,000 as an example, and you're either ready to do the plan or are in the midst of the plan. Obviously, if the rep agency revenue goes down 30%, that's roughly 350,000. Is that 3? Yeah, 450,000. So you're down at 1.1 million roughly. Well, if you're making a fixed payment, obviously that could be cost prohibitive. Now, add into that, if the buyout has a fixed number, obviously then the key people would also be overpaying for it. So if the revenue goes down to $1 million versus $1.5 million, and it's a kind of a slow uptick to get back to the $1.5 million, and they're making the payments based upon a stipulated value of 1.5, well, that's going to obviously have an impact on an existing buyout plan. So in addition to some cash flow restraints from the fallout from the virus, there's an additional cost that most buyouts don't take into consideration, and that's a bigger virus. I'm going to call it the IRS virus, because it's the burden of taxes on the plan. So it's bad enough that you might have a plan that has a fixed payout, that you're making payments on a higher number, but add to that the IRS virus, as I'll call it, because most buyout plans that I see are done as a stock plan. In other words, most buyout plans have maybe the owner's attorney or accountant says you need to have capital gains tax on this buyout, and they're not really familiar with rep agencies, and so they say basically sell your stock for $1 million in my example, and the buyers are buying it out for $200,000 a year to keep it simple. But the problem is, since a stock sale is non-deductible, that means it really costs the company and the buyers $300,000, because you have to earn $300,000, pay the virus, or get the haircut on the virus with the IRS of 35 to 40% to be left with the $200,000. So really, it's costing you or costing the buyers $300,000, not $200,000. So what to do? What do you do on that particular case? So what you want to do is you want to have two things. One is on the buyout structure, buyout payment terms, and two is on the buyout structure. So the buyout payments under your current plan that you're in, probably can amend it, or on a plan that you're anticipating incorporating, you want to make sure the buyout payments are structured as a percentage of annual commission with no floor and no ceiling, or potentially a percentage of the annual commission with a floor and a ceiling. So using my example of $1.5 million, it would be a percentage with no floor or ceiling. You could do that, or a percentage payout with a floor of $1,100,000 with a max of $1,800,000, something to that effect. So that's what you should do with an existing or future buyout. And then also you should relook at restructuring your payout, because if you have an existing plan, there may be an opportunity to restructure your existing plan, and the tax implication to this literally can make or break a buyout. I've seen situations, I've been involved when I get called by the buyers and they're paying an extra $150,000, $200,000 of taxes, and it's cost prohibitive, can't expand the company, and it's just killing them. So if you're planning on a future buyout or even have an existing one, you potentially could restructure it, because there are exit strategies that would lower, using my example of $1 million, rather than it having a net after tax cost of $300,000, the way we would restructure it using a variety, one, two, or a combination of these strategies, it would lower it to roughly $240,000. On average, if you can structure a plan a little bit more customized to a rep agency, we can leave the owner in the same net after tax position, but reduce the cost by roughly $300,000 per 1 million. Now we have our own succession planning process that we have, but through that, you want to look at either personal goodwill, net book value, stock and deferred compensation, an asset sale, ESOPs, and there's a variety of other ones. The one I would really just spend just a quick minute on is this personal goodwill. And so this happens to fit perfect with the manufacturer's rep agency, everyone, because personal goodwill is basically the concept of there's goodwill associated with your rep agency. Does that goodwill reside at the corporate level, or does it reside at the personal level? The problem with it residing at the corporate level, particularly if you're a C corporation, there is a significant amount of taxes to sell your corporate goodwill, there's a double taxation. So if you sell it as a personal goodwill, the buyers receive a 15-year write-off or a 15-year deduction, but it's fully 100% deductible. So if it was $1,500,000, to keep it simple, and if it was a 5-year buyout of $300,000 per year, they would be able to make a payment of $300,000, receive a deduction of $100,000. That goes for years 1, 2, 3, 4, 5. In year 6, there would be no more payment due, but the company would continue to receive the $100,000 deduction until year 15. And it just so happens the personal goodwill is a good fit for rep agencies because we make the argument or take the stance that the value of the agency in many occasions is your personal asset. In other words, if you went across the street, put up a sign and said rep agency, incorporated, called all your principals up, would you or could some of them potentially come over to you if you said, I'm starting up a new rep agency? And if the answer is yes, then the goodwill resides with you personally because it's a relationship business versus corporate. So bottom line is now's the opportunity really to take a look at revisiting your existing buyout or your planned buyout. Real quick, John suggested this, and I thought that was a great suggestion, to be honest. Unfortunately, it's a bad situation, but unfortunately, there may be some smaller vulnerable agencies that may be targets for a potential acquisition. So during this economic downturn, if there's a one-man agency, two-person agency, and they're kind of struggling, then this may be an opportunity not only for the existing agency to maybe save themselves, for lack of a better way of saying it, but there could be an opportunity to expand your territory, expand your line card, expand your employees. So now's a good time to look at that as well. So we've talked about kind of existing plans, existing economic conditions and how they impact it, and we'll review again at the end. What to do? What are the solutions to it? All that being said, what if you don't have a plan in place? What if you do have key employees and you want to be proactive? So what should you do to be proactive? So we have something called retention, incentive, and succession of key people, because there's a risk associated with you, whether you're losing them now during this economic downturn or into the future. So we're just going to walk through the step, and whether it was our risk management program or some other type program, here are the basic steps and the basic process of how you should really look at developing a retention and incentive plan for your key people. So step number 1, you got to identify who your key people are. So basically, I've categorized key people into 3 categories. 1, a key employee that helps the company grow, helps the agency produce the revenue, helps you as an owner, if you're an owner, receive compensation and take profits, but they're never going to be a successor. It's just not in their makeup. It's not in their DNA. That's category 1. Category 2 is the same person as category 1, but can be groomed to be a successor. And then category 3 is they are my successors. So in each and every category, there's different strategies that you can develop in order to retain and provide an incentive for them. But the first step is really to look at who they are and categorize them. And then the next is, one way or the other, have some type of independent assessment or interview with the key people. When we go through the process, we usually, quote unquote, interview the key people. Probably not the best word, but we do have a conversation with them. And many times, I'll, from my perspective of working with hundreds and hundreds of key employees, I might come back to the rep agency owner and say, you know what, you categorize that person as groomed to be a successor. In my opinion, they're ready to go now. There's always something very enlightening that happens through these conversations. And it'd be good to have an independent, objective assessment and an interview with the key people. Third is you want to review the compensation plan that you currently have with your key people, which we've talked about, which you can utilize with Brian Shirley and or with John's help. Then you want to look at, okay, how are we going to develop this retention and incentive bonus? So you should have some type of retention and incentive bonus that's in addition to the current compensation plan that you have. Obviously, it's not much of an incentive for a key employee if you say, you know what, Bob, you got a $20,000 bonus last year that you have to have and you needed to have your lifestyle. We're going to put that 20,000 somewhere else. That's not going to work. What you want to do is you want to have an additional layer of incentives that are tied to overall performance of the company, individual performance of the key person, and have an additional bonus in addition to what they currently receive. And then what happens is you basically, as an example, it could be whatever percentage you want, but just simply put, let's say that additional incentive bonus was $20,000. Well, what you would do is you would say, we'll pay out $10,000 to you individually. So they get extra cash in their pocket, which everybody wants and more than likely everybody needs, particularly at this time. But 50% will be set aside and it will accrue to their benefit. And that 50% will have a vesting schedule on it. And that'll be the kind of retention, and the fancy way that a lot of people talk about it is they call it golden handcuffs. This is a golden handcuff so that if they leave with only 10% vested, then they only get 10%. And the remainder of the dollars that were accrued to their benefit revert back to the company. So you really don't lose money. And obviously you don't want to seed a key person with money and provide an incentive for them, and then 3 years they leave and they take 100% of the money and now they go and compete against you. Wouldn't be fair. So you put on some type of vesting schedule on top of it. You could even say this vesting is going to be tied into the actual purchase or down payment of stock. So you could say, you know, this plan is 100% vested in 10 years, and or it vests automatically if you use the cash accrued for your benefit for a purchase of stock. So you can do that as well. So obviously, as I said, when it's fully vested, then they could use the accrued dollars personally and or for the purchase of stock, as we talked about. Then you want to go through funding. Okay, so where are we actually going to put these incentive dollars that we're going to have with a vesting schedule? So you want to either put it into a personal, you want to put it into an after-tax investment or some type of life insurance funding. Then ultimately, you need to codify this. You need to have, too many times I'll see owners that will set up like some type of like a life insurance plan, and they'll have this plan in place, and they'll be funding a life insurance plan, or they'll be doing some type of retention plan, but they don't formalize it. And so obviously you want bang for your buck. So if you're going to spend the time, spend the money to establish this, you should have it formalized, and you should be able to quantify it to your key people to show exactly what benefit they are receiving, and what a, for lack of a better way of saying it, what a nice person you are, or what incentive there is. So you really should then delegate it to have an actual formalized agreement and an actual tracking of what the benefit is to it. So you need a tax attorney basically to draft the agreement. So wrapping up, under an hour, this is good. So the goal of the webinar, again, I wanted the takeaways. We talked about the COVID impact in general, but more specifically as it relates to everyone here, what's the impact of the retirement and succession plan? Well, what should you do? You should have an updated valuation, one, as it's listed here. You should have a retirement cash flow model done so you can see what financial impact there is, and you should review your investments to make sure that it's not going to have a significant impact with another downturn in the market. Those are the solutions that you should do to protect against this economic impact on your retirement and succession plan. On the compensation of key employees, the takeaway for that is some form of a profit sharing plan, because A, you do want to treat them as financially as owners, the key people, and secondarily, the profit sharing plan is commensurate with what the actual revenue that's being generated, so it's not costing you out of pocket. On the existing buyout plans, you should have your payments as a percentage of annual gross commission, and you should really relook or revisit how you're planning on structuring or how they're currently structured, so that you can look at tax efficient exit strategies in general. If it's tax efficient, it really versus a stock sale, you should be able to save roughly $300,000 per $1 million, which again can literally make or break a buyout plan. And then 3, we talked about if you don't have a plan in place, how to protect yourself going forward. You should have some form of process outlined as I did there, whether it's through risk management or whether it's through another process that you use. You need to have a formalized plan in place and discuss it and review it with your key employees. And that's the end of the.
Great, John. So actually, before we get started, before we just wrap this, there's a couple of questions that have come up. Just curiously, just curiously, if people have received PPP funding, I know all of our rep firms are very interested in learning that. So we are going to launch a quick poll. If you don't feel comfortable talking through that or doing that, go ahead and just blow right through it. But it would be interesting to see how many rep firms there are. So one of the questions that's come up is, how should the PPP funding, if you do get funding, be treated as part of your income in this agency valuation? Is there any difference between that and commission income?
So can you say that again? Sorry, I'm looking at this other.
Yeah. So PPP income, how would PPP income be treated in agency compensation or agency valuation, I should say?
It wouldn't be. It wouldn't be, and it shouldn't be.
Okay. Even though that does improve your cash position in a sense, like your income for the year. Yes,
for sure. I don't think you should take that into consideration because that's not revenue generated. You know, I'm a capitalist, so yeah. Will I get my PPP from the government? Probably, but I'm not going to say my PP money was part of my revenue I generated. So I don't think it should be included. It's just a benefit to receive. You know,
okay.
Finally, we get a benefit from the government that we can utilize. Probably most people don't get on this call any benefits from the government, so this is probably the only time you'll get a benefit. So use it for cash flow purposes. Obviously, as we've talked about, or probably John has mentioned in other talks, you know, you can get these PPP forgiven.
Okay. Another question related to that, just from your personal experience, how many agencies do you see that when they do buyouts do not have a tax efficient process, as you pointed out in our conversation here? What percentage would you say?
Yeah, unfortunately, like 99%. Yeah, it's not good, and you know, it's unfortunate. You know, I don't know what it is. Well, I do. I think it's you count on kind of your accountant, and the analogy I use, John, is basically the rep agency owners are going direct because they're going direct to their accountant, and their accountant probably doesn't understand the rep agency as well as he should or she should, and then they're kind of in their own cocoon of how they're used to doing these big manufacturer buyouts that are typically done as a stock sale. So unfortunately, very, very, very high percentage are not taking advantage of it.
Gotcha.
John, can I answer this question that's up on the screen that someone asked?
Yeah, I was good. That's the would an S corp make more sense than a C corp for the buyer?
Well, it depends. It's actually a very good question. It depends on how you're buying it out. If you're stuck in a stock sale, then a C corp's better because think of it this way: a stock sale is non-deductible. Well, right now under current tax law, the C corporation tax bracket's 21%. And so under the assumption that a buyer is in a higher tax bracket, if you were an S corporation and you made a $200,000 payment that was non-deductible, that $200,000 would flow to your personal taxes. And if your personal tax rate's 35–40%, then you'd be better off as a C corp because a C corp's only going to pay 21% taxes on it. So it really depends on the type of buyout that is under place. If nothing's in place now, S corp by far is better to do because you would not want to do a stock sale. So S corp for everybody that's attending is literally a no-brainer for everybody to do because of various items. The number one item being the 199A deduction, which you get a 20% deduction on your profits as it relates to your taxes each year.
So how do I get rid of this? I do this problem. How do I get rid of the question?
I'm not sure.
Hopefully it was answered.
Yeah, no, I think you got it. Yeah, and then and I think just kind of the final piece, we're just going to. So first of all, John, thanks for sharing this information with us. I hope everybody on the line has found it of value. We've got some additional webinars coming up, as I pointed out. You can see those at repfabric.com/blog, and definitely invite you to the May 15th Rep of the Future. Again, it's a track that we've presented before at a few of the different rep seminars through various trade associations. It's been extremely well received. Hope you guys can make that. I'm also going to just introduce one last poll of the different topics that are of interest to everybody, because we are in this mode of switching gears somewhat and selling from the inside out. So if you guys are interested in more topics here, we'd like to pull in experts in these various areas and be able to provide upcoming webinars to you on these subjects. So John, once again, thanks very much. I highly encourage you to reach out to John. He's excellent at what he does. If this is something that is on your mind, something that you're thinking about, and he'll treat you well. So thanks again, everybody. And
thank you, John. Thank you, everybody.